Bitfarms reported first quarter earnings earlier this week. The Bitcoin miner ramped up its stated time frame for reaching 6 exahash per second of computing power as its quarterly loss per share narrowed. Joining us now to discuss is Bitfarms CFO Jeffrey Lucas. Welcome, Jeffrey.
Hey, George. Very pleased to be here.
Yeah, glad to have you. So, Jeffrey, what's the key takeaway from your latest earnings report?
Sure. Very glad to share that. First, let me just begin by giving a context of what Bitfarms is and who we are here. We are a vertically integrated Bitcoin miner. We have about 196 megawatts of production capacity, geographically diversified among 10 farms in 4 countries. 7 farms we have in Quebec, Canada, 1 in Washington State, 1 in Paraguay, and 1 in Argentina. We are about 95% powered by hydro renewable energy. And the beauty for us is that this is actually a very stable, low-cost energy that places us among the lowest-cost producers in the industry. So we are at about 5 exahash per second currently, and that's an improvement from about 4.8 exahash at the end of our March quarter. We've been in business now for about 5 years, since 2017, and I'm pleased to say we just announced that we've mined our 21,000th Bitcoin entirely from hydro. That's 1/1000th of the total Bitcoin that will ever be mined. And as you pointed out, George, we just came off a pretty strong first quarter. Let me give you some figures here. We had revenues of about $30 million, and we mined about 1,300 Bitcoin. We achieved adjusted EBITDA of around $6.3 million. That's up pretty much exponentially from the $1.1 million of adjusted EBITDA that we had in the fourth quarter of last year. To give you a bit of a context, I'm sorry, were you going to ask a question?
No, I wasn't, but go ahead, finish that thought, and I'll get to you.
So we take great pride in actually being a low-cost producer. Let me give you some hard numbers as a point of context here. Our actual direct mining cost, which is our cost of electricity, was around $12,500 per Bitcoin in the first quarter. Our total cash cost actually was about $17,600. And think of that within the realm of the fact that our average revenue per Bitcoin in the first quarter was around $22,500. So overall, we were in a pretty strong position for the quarter and look forward to that continuing going forward here.
Right. Jeffrey, I have a question for you then. So Bitfarms is a publicly traded company, and your stock has risen a lot over this year. But that is probably mostly due to the fact that Bitcoin's price has increased. What say you to the investors who look at Bitcoin and see Bitcoin performing better and or worse than your stocks and how it moves day to day? How do you deal with the volatility of Bitcoin in your business?
You know, that's really an excellent question. We actually keep our eye on the long game here. And let me start off by saying that there are 3 overarching objectives that we have that we think about every day, each and every one of us. First is the achievement of operational excellence. And in so doing, we can be and continue to be one of the lower cost producers. Secondly, we have a term here, George, we call it accretive intelligent growth. We're not seeking growth for growth's sake. We are seeking growth that makes a lot of sense for us and is in the best interest of our shareholders. And that's why we call it accretive intelligent growth. And thirdly, we have a very solid financial position here, and that's evidenced by our strong balance sheet. To give you a context of what has made us more attractive, particularly institutional investors, over the past 9 to 10 months or so, in June of last year, we had about $165 million of debt. We've been working to pare that down, including negotiating some payoffs with BlockFi during the reorganization, that today we have less than $20 million of debt outstanding. So again, overall, we enjoy a very attractive cost structure. We have some very intriguing growth opportunities, including Argentina, which I'll speak about in just a moment here. And we have a very strong balance sheet to position us very, very well for here going forward. I will tell you, George, that what gets us very excited and is capturing the attention of a lot of the analysts on the street here and also institutional investors is what we've done in Argentina. We've actually begun transitioning in Argentina, now actually up to full mode production here. We have been in the past about 8 megawatts of power there. We've now brought that up to 18 megawatts actually over the past 2 weeks. And we've got about additional 32 megawatts or 50 megawatts in total of built out capacity that's available to us. That's already paid for, ready to go once we populate that with miners, which we're in the process of doing now.
Right. So you talk about Argentina and growth, and you've talked about your balance sheet, but my understanding is that in January, your firm warned that it might default on some of its debt. Have those worries subsided?
Well, the reason we made that statement here was twofold. First of all, we were taking a bit of a risk in our negotiations with BlockFi. And our goal there was at that point in time, we had $21 million of debt outstanding. We knew, like the rest of the industry, that the miners that were collateralizing that debt were dramatically lower than the value of the debt and what we had originally put in place when the loan about a year earlier here. So we have an obligation, a fiduciary obligation, to disclose to the world there can be risks associated with this negotiation. And secondly, we wanted to sort of help our negotiating position vis-a-vis BlockFi by being prepared to take the position of going the long haul here. Fortunately, we didn't have to do so. We have a very good relationship with BlockFi. We were able to pay off roughly $21 million of debt with a little over $7.5 million of payment. And we did not have to surrender any collateral whatsoever. And the remaining miners, the approximately 6,000 miners that were collateralized in that loan, now became entirely free and clear. That was purely the reason behind that.
Right. So we have this balance sheet risk. You say that it's no longer there. What about geographical risk? You've talked about Argentina. You've talked about Paraguay. Is there some sort of risk attached to opening these mining farms in locations that might not be as welcoming necessarily to Bitcoin miners as, say, maybe a U.S. jurisdiction? I know Texas is a welcoming place, but not every place in the U.S. is welcoming. Is there some sort of geographical diversification risk here as well?
Well, there are indeed implementation challenges. You're going to find that in any country you go to. But actually, quite frankly, it's a diversification of a lot of the risks which you speak to. We do not have the concentration. We're reading every day, of course, about further regulations, additional taxes, such as Biden's Dame tax, things of that sort. By being geographically diversified as we are, we've really spread out that risk pretty effectively. And by the way, we are very, very selective in the companies and where we build up our operations. We try to do as thorough an assessment as we can of what the underlying risks can or may be before we proceed to invest in those countries.
Awesome. That makes sense, Jeffrey. Jeffrey, thanks for joining us, and thank you for sharing your time with us.
George, I'm glad to do so. Thank you.
Yep. That was Jeffrey Lucas from Bitfarms.